Welcome everyone, this is lecture 6 in the miscellaneous series of lectures which are designed to apply economics and economic theory to reality and help people understand how economics is useful and what certain things really mean. This is a group of friends and colleagues who trade and some of them trade on Forex Markets, and they asked me if I could explain how the exchange rate is determined. And I said, yep, no problem, that's easy. And then of course they wanted to know whether I could predict what the exchange rate is going to be, and I had some good news for them and some not so good news, but I'll explain that as we go along. The foreign exchange rate of sterling was certainly less of a mystery when exchange rates were fixed before 1972 in the UK, but became almost an unfathomable mystery once the Forex rate was floated in 1972. I remember many years ago a young Forex trader telling me that he might as well close his eyes and throw a dart at a board and be guided by the number he hit through the trading day. This random approach broke even, but as he gained experience and developed a trader's nous, so he started to aim with eyes open and with more precision, and this improved his odds of winning, he thought, to around 60 to 40. The only reason I'm reminded of this is because you cannot beat experience, and I'd replace nous with knowledge of economics. Economics can explain lots of these things. More recently, a close friend and an experienced trader this time asked me if my economics could explain what was happening in Forex markets. My answer was yes, in as much as the Forex market is one of the best examples in economics of how supply and demand determines price. He then asked if I could predict what was going to happen in the markets, and I said yes. Long-term trend, I have no problem with that, but what's going to happen in the next 5 minutes, I have very little idea. Economic models, no matter how simple, are a great first step towards understanding the real world, despite what a lot of economists say, a lot of criticism of simple economic theory. But let me just illustrate, I will digress just for a moment to do a little bit of boasting and explain why I think economic modelling is important. In the 1970s and 80s, I was teaching theories of the firm, and the ongoing criticism, mainly by other economists, was that these are idealised models using geometry and algebra, and they have no relevance to the real world of business. I explained that understanding economics was very important to the success of a business, and their response was, you can't prove it, can you? Now, I was not ever going to run my own business as I went into education for an easy life, and I have the greatest respect for entrepreneurs who are, in my opinion, the real source of economic growth in an economy. I always tell my students, if you see a millionaire or a billionaire getting out of a Rolls Royce and they've made their money in business, then go over and thank them. If you see a politician or one of the bureaucracy jumping out of these big expensive cars, then by all means go across and tweak them on the nose or whatever. It is very important from my point of view, from the sort of capitalist standpoint, that we recognise that the real source of success comes from what people do in their everyday business. However, there was an opportunity at the time to prove my point, because the Institute of Chartered Accountants, ICL, the old computer company, IBM, the Times, the Sunday Times, the Financial Times, were all among bodies who started to run what were called management games or business games. And these attracted competitors from all the top companies, many are from around the world, and certainly all the top UK companies and top accountancy firms and top consultants. These games used computer simulations to create a competitive industry. Each firm or competing team started in an identical situation with regard to production, pricing, marketing, finance capacity. They had identical balance sheets. They had profit and loss accounts. So everything was identical to start with. And over 5 or 6 trading periods, each team would change its price, its capacity to produce, its research and development budget, its marketing, its transport capacity, etc. And at the end of the game, the team with the highest profit won, and the team moved on to the next round and eventually to a final. Now, with my students, and it was just economics that was guiding us. So these were my economics students. With my economics students, we produced teams to challenge the best firms in the world with our knowledge of economics and not much else. Over 18 years, we won 14 national titles. In 1981, we played over 2,000 national and international companies, and through to a final in London, we won the Financial Times Rose Bowl. I seem to remember we beat Shell, the oil company, and 3 others in the final. In 1997, I was going to take a sabbatical from education because I needed to write some books and I had some thinking to do, but I was asked to play in a Champion of Champions competition for former winners, where I played against who was my arch nemesis at the time, someone from Lombard North Central, if you remember that company, and I won. And I've never played again, hopefully having proved my point that if you know your theories of the firm, you'll understand business and you'll be able to knock anyone out of, well, at least business games and competitions of that sort. You can no doubt freeze that should you be interested, but that is a list of all of the national competitions that we won. There are lots more that we sort of came second or third in, but those were the ones that we actually won, so you can freeze that and check them out if you disbelieve anything that I've told you so far. Back to exchange rates. So the question that I was originally asked. Because the Forex market is one of the freest markets in the economy, the rules of supply and demand actually apply. Now, this may be new to some. If you've seen my other lectures, it won't be so new to you. And if you understand a little bit of economics, it won't be too much of a problem for you. But that's a simple foreign exchange market. On the vertical axis, you got the price. Now, if you're measuring the price of pounds or sterling, you can't measure it in pounds or sterling. You've got to measure it in another currency. In this case, it says dollars. So it's often a mistake of people when they put pricing on the vertical axis to put the sterling sign to measure sterling. You can't do that. You've got to choose any other currency if you want to measure the foreign exchange price of a currency. And on the horizontal axis, you can have the quantity of pounds that gets exchanged. And there's a supply function. As the price of sterling goes up, the demand for imports in the UK increases because imports are now cheaper in terms of sterling. So you supply more currency to the foreign exchange markets when sterling goes up in price because you will demand more imports which are now lower priced in sterling. Same price in the foreign currency, but now lower priced in sterling. The demand curve is determined by the demand for exports. So it's foreigners who are demanding sterling to buy our products. So when the price of sterling goes down, they demand more. And it's often, again, confusing for people because it's actually two demands, demand for imports, demand for exports, that determines the supply and the demand for currency. Now, for those among you who are purists, and I won't go into much detail and explain this, although it is explained in one of my other lectures, that supply function for currency to the foreign exchange market is based upon the assumption that the demand for imports is elastic. If the demand for imports is inelastic or unitary elasticity, the supply curve is a different shape. But that hopefully makes it easy for you to understand, and you can always ask me to explain that in more detail on another occasion, should you wish. So, the nice thing in diagrams, supply and demand diagrams, is that where the demand curve crosses the supply curve, you get an equilibrium exchange rate. It's the exchange rate at which the quantity of currency demanded is exactly equal to the quantity of currency supplied. That's obviously changing a lot under the current system, a floating system, but doesn't change, as I'll explain in a moment, except under exceptional circumstances when the exchange rate is fixed. So yeah, the foreign exchange market is a market which is simple to explain. It's just supply and demand that determines the price of a currency. In fact, in terms of what is called a perfect market in economic theory, foreign exchange markets are often used as an example which gets close to being a perfect market. Nothing, of course, is perfect, but it gets close to being a perfect market. However, there is an important analytical difference between long-term price trends and short-term fluctuations. And of course, it is the short-term fluctuations that traders are interested in. As I had applied the theories of the firm and shown that they do work in reality, so, well, not quite reality, I know there were simulations, but you know what I mean. So I decided to apply my knowledge to the Forex markets. I decided I would learn more by trading minuscule amounts of currency on one of the trading sites. Relying on my knowledge of long-term trends, I was unbelievably unsuccessful almost every time that I made a guess on what was going to happen to the currency. But when I concentrated on just things that might disturb the market in the short term, then I was much more successful. You know, a guess on what a set of figures will be when they're announced at 9 o'clock this morning, or a rumour going around the markets, or action by one of the big players. I remember one of my former students, when I asked him, how much do you use your economics when you're trading? He said, we don't, we just follow what the big people do. So the big players obviously influence, a sudden death, a bubble just about to burst, a president getting impeached. Any of these things suddenly disturb markets, and the trader is really in there looking at minute-to-minute changes, second-to-second changes, not the long-term trend. The interesting thing was the extent to which short-term perceptions drove the market, irrespective of whether the ideas were right or wrong. It didn't matter, as long as people believed them, then they drove the market in the short term. So the long-term direction may be down, and I'm absolutely certain of why that is the case, but the currency itself may shoot up in value in the next few minutes. Very difficult to tell. I suppose my traders are going to turn off now, but I will say a little bit more about that, and you might find it helpful to understand exactly what happens over the long term in foreign exchange markets. To understand more clearly the long-term trend, I'm going to look right the way back to the 1960s, when under the gold exchange standard there were only long-term factors determining prices. And I'm going to compare a situation where there were many overriding short-term factors with one where there are only long-term factors. In the 1960s, the exchange rate was fixed, but it was still determined in the market by supply and demand in exactly the same way that I have described it to you. It's a mistake to think that a fixed exchange rate is actually fixed. It's just that the Bank of England would intervene by buying and selling the currency to maintain a particularly chosen par value. In this case, early in the 60s, it was $2.40 that sterling was fixed against. So you can see the supply and demand curve still there, doing exactly the same thing, determining the price at 2.40. And the Bank of England would allow a margin of fluctuation. The sterling could go down to $2.38 or it could go up to $2.42 before the bank would intervene and buy the currency by selling foreign currency. So buy sterling, which increases the demand, shifts that demand curve to the right and will bring it back up if it's getting close to $2.38. Or the other way around, if very unusual of course, but if sterling was rising and likely to breach the $2.42, then the Bank of England would sell sterling into the market and buy foreign currency in order to bring the price down. So that's all a fixed exchange rate is. It's a central bank guaranteeing a par value and limits outside. It won't let the sterling rise or fall. So there are no real opportunities here. You've got a little bit of scope between 238 and 242, but there's very little scope to speculate except in one case. So most of the time activity in the Forex markets was driven by the real demand and supply of currencies, which in turn is determined by the import and export of goods and services and a relatively small flow of capital between countries. Now remember, it is the demand for imports that determines the supply of currency and the demand for exports that determines the demand for currency. Now when measuring the long-term health of an economy, the most overlooked and yet in my mind the most important statistic is the balance on the current account of the balance of payments. This is what will tell you the long-term trend in a country's currency. If you want to understand how an economy is performing and how sustainable its economic growth is, then just look at the current account balance. Officially, it's often ignored and there are attempts to play down its significance. After all, it is only just a few years away from an election, so the very short term is considered much more important than the long-term strength of the economy and its economic health. So politicians, governments tend to ignore what's happening on the foreign exchange market and ignore what's happening to the current account of the balance of payments. But let me explain to you what is actually going on. I wrote this a few years ago. In 2016, I explained that an economy in dire straits was not an underestimate of the then damaged state of the UK economy, and indeed of many other Western economies. The current account statistic that illustrated that damage was 7.6%. That was the last quarter's deficit on the current account of the balance of payments as a proportion of real gross domestic product. I recently read that an eminent economist could not understand why the UK was continually in deficit on the current account when the economic theory says that the foreign exchange rate should always correct imbalances. It should go up and down and make that correction. Now this person was a Keynesian economist and the whole of their macroeconomic theory is founded upon a number of fallacies. But before I explain why the UK has had a continuing deficit alongside a floating exchange rate system, I will unravel the accounts on the balance of payments and explain how they are related and their relative importance to long-term sustainability of both living standards and of exchange rates. The balance on each account of the balance of payments is always the difference between two totals. It doesn't tell you how big these totals are, it's just the difference between two totals. Overall, the balance of payments will always produce a zero balance, which has led some economists to say, well, if it's a zero balance, why do we bother? And it certainly prompts quite a lot of people just to ignore the accounts. Our modern monetary theorists will attest to that. However, it is the balance on each account that is important, and none more so than the current account balance. Over time, the separate accounts on the balance of payments have been given different names. Sometimes I think it's in order to draw attention away from the relative importance of these accounts. We had many years in the 70s with big current account deficits, and whoever nudged the media, I don't know, but they started to report these as capital account surpluses, which they are. Capital account surpluses sounds much better than a current account deficit. Now, the easiest way to understand the overall balance is to separate it into two accounts. That's the current account and the capital account. The current account balance is the difference between the total value of goods and services sold abroad, that's your exports, and the total value of imports purchased from abroad. It's measured in the domestic currency, and it's over a specific period of time. The capital account, however, includes just transfers of ownership of assets, plus loans and deposits made between countries. Now, inside the capital account is the number that will always produce the overall zero balance. In the UK, it is the official financing number that offsets the deficit or the surplus which results from all of the market flows of currency on both current and capital account. So it always produces the naught. When you have a plus number, it puts a minus number in exactly equal and opposite. When you have a minus number, it puts a plus number in equal and opposite by running down its own foreign exchange reserves or building up its own foreign exchange reserves or borrowing or lending abroad. Now, the 7.6% deficit that I referred to as a proportion of real gross domestic product translated at that time into a current balance deficit of £96 billion for 2016. The reason that the current account is significant while the capital account is insignificant relates directly to current standards of living. Putting it simply, we consumed £96 billion of imports in that year that were not paid for by selling exports. In one sense, that was a very good year for our standard of living, but it's unsustainable as we had to borrow from other countries or run down our own foreign exchange reserves or sell our assets to cover that gap. And we have only a finite number of assets to sell or foreign exchange, and all of these monies borrowed will require repayment and interest charges to be covered. Now let me explain to you the cause of the problem that caused this continuing fall in the exchange rate and a correction in the current account which didn't take place. We noted earlier that some economists are confused by the fact that changes in the foreign exchange rate of sterling are not correcting the imbalance on current account. Before we progress with the analysis, it's necessary to define two terms clearly so that there is no confusion. A current balance deficit refers to the value of imports exceeding the value of exports over a specified period. A fiscal deficit refers to a domestic imbalance on the government's budget where their expenditure exceeds revenue from taxation over that fiscal year. To explain things clearly, it's useful to return to the days of the fixed exchange rate pre-1972. During this time, it was not possible to run a large or sustained fiscal deficit without imposing financial pressure on the exchange rate. The reasoning behind this is that a domestic fiscal deficit expands aggregate monetary demand. This increases the demand for imports, and it makes the domestic market more profitable for what would have been potential exports. So some domestic production gets redirected back into the home market. The ensuing current balance deficit indicates an overvalued exchange rate, and this makes it difficult to maintain a fixed value for the currency. This expansionary process needed to be reversed, and this was the actual cause of the post-World War II stop-go cycle, which should really have been renamed the go-stop cycle. But let me again illustrate just by reminding you of that diagram there. That's the situation where the government is trying to maintain, in this case, 240. And it's not letting you go outside this band of 238 and 242. Moving on from this, it's now necessary to look at what happens when the exchange rate is floated. It's now possible to run a fiscal deficit and let the exchange rate take the strain. Only one fiscal deficit will probably lead to a current account deficit, a downward adjustment in the exchange rate before the current balance deficit is corrected. The problem is that, as well as a lot of other variables, there is a tendency for one fiscal deficit to follow another, and the exchange rate ends up trying to play catch-up. Various techniques can be and have been used to slow down the adjustment to a lower rate of exchange. For example, if you keep your interest rates slightly higher than world rates, then the country in question will attract asset purchases and deposits that can cover the shortfall in foreign currency caused by a current balance deficit. Alternatively, as happened in 2009 when we returned to a sort of Keynesian demand management attempt to get out of the global financial crisis, Keynesian economists actually persuaded all the G20 countries to run fiscal deficits, which damaged their domestic economies, and the fallout for that is still being felt, but tends to leave relative exchange rates unscathed. In other words, all economies are going down together and exchange rates actually look very stable. To conclude this point, we can say that a deficit on the current account of the balance of payments is the sign of a significant and unsustainable malaise in an economy. Since the exchange rate was floated in June 1972, the main cause of current balance deficits is governments overspending their budget. The fiscal deficit precedes the current balance deficit, and a series of fiscal deficits continues to cause current balance deficits, which in turn push the exchange rate ever lower as the economy weakens. An obvious solution is to legislate against governments being able to run continual fiscal deficits, and I have suggested in another lecture that governments should be forced to balance their budgets over a 3-year term. And I have absolutely no doubt if that happened, then the current account of the balance of payments would move back into an equilibrium position. Now, before I bring you up to date on the current account, I want to remind you that if under a fixed exchange rate system we look at the difference in the value between the total amount of goods and services sold abroad and the total amount of imports purchased from abroad, and if we find a continuing surplus, it shows that the currency is undervalued. And if anything is going to happen to it, it's likely to be revalued, which means being moved from one fixed point to a higher fixed point. And this assumes there's no domestic corrective action, because you can actually go into reflationary policies or the opposite of reflationary policies, which I shouldn't really mention because they're called deflationary policies, not to be confused with deflation, which is a fall in the average level of prices. But a continuing deficit on the current account meant that the currency was overvalued, and if anything, it was likely to be devalued. Now, under a fixed system, there is, as I've said before, hardly any speculative activity, as central banks were fairly adept at maintaining a fixed par value for the currency. However, if things go wrong, and it looks as though you're moving outside the market price, and things did go wrong towards the end of the 60s when government tried to use Keynesian demand policies, fiscal deficits, for several years, and caused a real imbalance, deficit on the current account of the balance of payments, because this meant then the currency was now being recognised as being overvalued. And a few people recognised this because it's what's called a speculator's paradise, because a series of current account deficits signal the likelihood of a devaluation, which means moving from one fixed point to a lower fixed point. And therefore shorting the pound was going to be a real money spinner. There was no risk of a rise in the value of currency because of the continuing deficit. So if the currency was devalued, the speculator won. And if it wasn't devalued, the speculator did not lose. That's what a speculator's paradise is. You only either win or you don't lose. In 1967, those shorting the currency made 14% over one day when there was a 14% devaluation in sterling. In the 70s, things changed when exchange rates floated. And to provide some stability for trade, a number of new markets grew up. These markets hadn't existed before then, and I suppose one could describe these markets as becoming a gambler's paradise. These included derivative markets, the forward markets for futures, swaps and options. They opened up a whole new world for speculation, as small changes in currency and large geared funds created a new career in trading. So what has changed between the 1960s and now is that in the 60s, almost 100% of business on Forex markets was driven by real demand for imports, which supplied the currency to the market, and demand for exports, which demanded currency from this market. Now, however, probably less than 5% of Forex deals, Forex trade, is driven by real factors. 95% or more is driven by speculative decisions that are based upon expectations, unexpected outcomes, new information, rumours, crackpot theories, to mention but a few. Any Forex site will give you dates for important decisions, the release of relevant statistics or important information. And looking at just one of these variables, interest rates, we can see that just expectations of a rate hike causes significant changes in the currency value. And that's expectations, because over the last 10 years there's been hardly any change, but expectations that there might be a change causes a real disturbance in the market, which those with the nous, with the traders' instincts, can take advantage of. Also, the direction of change in the currency is often opposite to the long-term trend, as I illustrated earlier, because it's only going to be there for a few minutes or a few hours or a few days at most. Knowledge that just one member of the Monetary Policy Committee voted against a rate rise this time will cause the value of the currency to rise in anticipation of changing things, while information that 2 members have voted for a change will have an even greater effect, and so on. Now let's just pull all of this together. Large and continuing current balance deficits on the external accounts of the UK and the USA mean that the currencies are currently overvalued and in the long term will fall against a basket of all other currencies. In contrast, a large current account surplus in China means the yuan is undervalued and over the long term will rise. However, looking closer at the China situation, we can see that recently the short-term value has been bucking the trend and the yuan has been sustained at an undervalued rate. And this is because of the power and influence of the Chinese government and central bank, who are concerned that a shrinking surplus will reduce their ability to buy favour around the world. And they are able to push against this trend and keep the yuan low, which means they're earning a lot of foreign currency that they are not putting back into the real economy. They're using themselves to go and build roads in Africa, buy up a few estates in the UK, which is therefore the Chinese government which is controlling this particular situation. This, however, will not continue without a correction, as the long term is for yuan to go up, and that long-term trend will likely mean the market has the final say in this situation. The pandemic, if you're listening to this in years to come, that was when we became very worried about COVID and spent a year sitting at home doing very little while we waited for governments around the world to try and sort things out. The pandemic has had little effect on the current account in the UK. A continuing large fiscal deficit is still sucking in imports, leading to a last quarter deficit in 2020 was £15 billion. However, the even bigger deficit in the US, and at the moment greater concern about inflation in the US, has actually led to the price of sterling rising against the dollar. Even though they're both falling, the price of sterling is rising against the dollar. As we have explained, the long-term price of a currency will be closely related to the current account of the balance of payments. Between all countries, the imbalances on the current account will balance each other out, meaning that at any point in time, those countries with surpluses will be undervalued and trending up, while those countries with deficits will be overvalued and trending down. One more interesting and confusing point is that all of those countries with deficits on their current accounts will, on average, be falling when measured against a basket of all the world's currencies, but individually they may be rising or falling against each other, depending upon which country has got the largest deficit on their current account, and although they're all falling on average, when you measure them against a basket of other currencies, they're all rising and falling between each other. This means that individually, just to take an example to illustrate that point, if one country in deficit has, say, a 5% rate of inflation and another has a 10% rate of inflation, then the 5% country will see a rise in its exchange rate relative to the 10% country, and obviously vice versa. In other words, one will be falling more slowly than the other and therefore be seen to be rising. To recap, it is necessary to look at a country's current account balance to determine the long-term strength of its currency. And then listen carefully to the tittle-tattle in the markets to determine any short-term fluctuations. And if you act quickly enough, or if you're privileged to receive information first, then you can make money in the Forex markets. But remember that the Forex markets produce a zero result, in as much as everyone who gains will be matched by an equal number of people in terms of value who lose. So always be careful when you get into trading to perhaps spend plenty of time practicing and looking very carefully at short-term fluctuations. Always have at the back of your mind what the long-term movement is going to be, but short-term fluctuations are determined by something which is completely different from that which determines the long-term trend. Thank you for all of that. Hope you enjoyed it.